Let me ask you something. Have you ever traveled or bought something online from another country and suddenly felt like, wait, why is it so expensive in my currency? Or the opposite. You see something priced at a small number, but when you convert it, it becomes shocking. And then people say things like, wow, their currency is stronger. Our money is weak. Dollar is rising. The exchange rate is crazy. But most people don't truly understand what's happening. Because exchange rate isn't just a number on Google. It's not just something for travelers. Exchange rate is a silent force that decides how expensive imports feel, how profitable exports become, why prices rise, why a country can feel richer or poorer overnight. So today, I'm going to explain exchange rate in the simplest way possible. With a story about one strange product, a product every country secretly sells without putting it on a shelf. That product is called currency tickets. Imagine the world has a special marketplace. Not a normal market with food or clothes, but a market where every country sells one product. A currency ticket. Each ticket is a piece of paper that lets you buy things in that country. For example, if you want to buy food in the United States, you need USD tickets. If you want to buy things in Japan, you need JPY tickets. If you want to buy things in Indonesia, you need IDR tickets. Now, here's the twist. These tickets don't have the same price. So, in the global market, there's a giant digital price board. And on that board, you see something like $1 equals 15,500 IDR, $1 equals 0.921 euros USD equals 150 JPY. That number is the exchange rate. In the simplest words, exchange rate is the price of one currency compared to another currency. That's it. It's like comparing the price of two products. Just like one bottle of water equals 2 slices of bread, one movie ticket equals 3 coffees. In currency, $1 equals 15,500 IDR. It means to get $1 ticket, you must pay 15,500 IDR tickets. Now you might ask, why does money have a price? Isn't money already the price of things? Yes, but here's the truth. Money is not universal. Different countries have different currencies. And when trade happens, when tourism happens, when international business happens, currencies have to be exchanged. It's like traveling to a different theme park. Imagine you enter theme park A. Inside, you can't use cash. You must use their special coins. So the first thing you do is exchange your money for their coins. That exchange has a rate. That's exactly what happens in the real world. When you buy something from another country, you are not only buying the product, you are also dealing with the price of currency, which means exchange rates quietly affect your life, even if you never leave your city. Let me tell you a simple story. Two friends, Ryan lives in country A, and Daniel lives in country B. They both want to buy the same exact product, a phone that costs $1,000 USD. Ryan earns money in his local currency. Daniel earns money in a different local currency. Now, if their exchange rate changes, the phone becomes cheaper or more expensive for them, even if the phone price stays the same in dollars. That's the crazy part. The product doesn't change, but the exchange rate changes the reality. So sometimes people say, why are things becoming expensive? And the answer is, maybe the product didn't get expensive. Maybe your currency changed value. Exchange rate can do that. It's like the invisible translator of prices. Now let's talk about the word people fear. My currency is weakening. What does that mean? It means you need more of your currency to buy the same amount of foreign currency. Example, yesterday, $1 equals 15,000 IDR. Today, $1 equals 16,000 IDR. That means the IDR weakened compared to the USD. So now, imports become more expensive. Imported goods like smartphones, laptops, car parts, fuel in many countries. Medicines, international subscriptions, even food ingredients can feel more expensive. Because to buy those goods, companies need USD. And if USD becomes more expensive, they pay more in local currency. Then what happens next? Companies raise prices. People feel it in daily life, so the exchange rate can influence inflation. Not always directly, but very often. Now, the opposite. If your currency strengthens, imports feel cheaper, foreign things feel more affordable. That's why some people love a strong currency. But there's a catch, and we'll get to that. Now, I want you to imagine the world economy as a river. Money flows like water. When a country sells products to the world, foreign money flows in. When a country buys products from the world, money flows out. So, exchange rate is affected by flow. If a country receives a lot of foreign currency, people want that country's currency more. Demand rises, its currency can strengthen. But if a country needs a lot of foreign currency and sells less to the world, then foreign currency demand becomes high. Its currency can weaken. So, one of the biggest drivers is supply and demand for a currency, just like any product. If a currency is in high demand, its price rises. If people don't want it, its price falls. Currencies are traded like products every second, even while you sleep. Now, the real question, why do exchange rates move? Why do people wake up and say, dollar is up today? Here are the main reasons. First, interest rates. If a country offers higher interest rates, investors may move money into that country to earn more. More demand for that currency equals currency strengthens. Lower interest rates equals currency can weaken. Second, inflation. High inflation often weakens a currency over time. Because money loses purchasing power, people trust it less. Third, economic strength, GDP, growth, jobs. If a country's economy looks strong, investors and businesses feel confident, demand for the currency increases. Fourth, trade balance. If a country exports a lot, it earns foreign currency. That can support its own currency. If a country imports more than it exports, it may need more foreign currency, weakening its own. Fifth, political stability. Money loves safety. If investors feel a country is risky, they pull money out. Currency weakens. Sixth, market emotions. This is important. Sometimes exchange rates move because of fear or hype. Markets are not always logical. Sometimes one rumor can move billions of dollars. Exchange rates are not just economics, they are psychology. So, let's lock this into your mind. Exchange rate is the price of one currency compared to another. It's the invisible price tag on every country. When your currency weakens, imports become more expensive and life can feel heavier. When your currency strengthens, foreign goods feel cheaper, but exports may suffer. So, exchange rates are not just numbers, they're signals. They tell you how the world values a currency at that moment in time. And the next time you hear someone say, the exchange rate is crazy, you'll understand it's not magic, it's not random, it's the world buying and selling trust with money as the product. This channel exists for those who are ready to rise. If that's you, like the video, subscribe, and let this be your daily reminder